Today's market call is brought to you by MoneyLion, the first digital ecosystem for consumer finance, empowering everyone to make their best financial decisions.
All right, welcome to Market Call. I'm Dan Nathan. That is Carter Worth of Worth Charting. Carter, welcome to the program this morning.
How goes? Good weekend?
Yeah, I actually ended the weekend with a bit of a head cold, but, as Guy would say, I'm playing hurt. Guy is actually not playing hurt. He's playing. I'm not going to dox him. He's off for the week, well-deserved vacation. So I appreciate Carter being here with me for the full time. He's going to be back with us on Wednesday. Carter, did you have a nice weekend?
I did. It's not quite slow down time, but this obviously, as we approach the holiday shortened week, it'll be a little quieter. So it's a welcome thing, I think, for one and all.
Yeah, those are always really interesting periods. You have weeks like this around Thanksgiving where you have, a half day and then a full day off towards the end of the week, that sort of thing. And, sometimes folks don't have a hard time pushing around stocks, right? And I think the interesting part about this week is that today is obviously quarter end, and it's been a heck of a quarter. We'll go through some of the stuff, at least some of the price action that we've seen a bit. There's no real earnings this week. We have Tesla's deliveries on Wednesday morning, and that's shaping up to be a really interesting one, and we'll maybe go through that a little bit. But Carter, I want to start with something here. Our friend Doug Gass over at Seabreeze, he had a note out this morning, and he was kind of giving a few quotes here, and I think it's kind of interesting here. So Doug writes for thestreetpro.com, and he has pieces throughout the day, but he was talking about, like, for instance, Jim Cramer feels the speculative runaway may continue for years to come, much like it did in the dot-com era. I think a lot of folks forget, and I know you do not, from 96 to 99, the S&P on average was up 25% a year. It was truly astounding. But what most people forget is how much volatility there was in some of those years. Speak to this a little bit, because if we're off to the races, if this is for years to come unabated, you have Dan Niles, who, friend of the pod, says, forget about valuations. We have this consumer or investor optimism going through the roof, which Doug is kind of chronicling here. Give us a sense of when you start hearing all these things come together, what does that mean to you?
Well, there's so many ways to respond to that. In terms of years to come, let's just focus on the words used, the phrase, that no one can speak out for years. This is the issue. There are only three time frames when it comes to investing. If you think about it, there's minor, intermediate, and major. Minor is a couple weeks, couple months. That's quick in and out trading. Majors, Apple's been on a major move last 30 years. And talking about looking out through 3 years, no one has that insight. No one. Where alpha is truly generated, unless you're just going to be buy and hold it for the long term, is on an intermediate basis. It's sort of that 7 to 12, 8 to 11 month period where you really are playing chess, right, against the best and brightest, whether it's Louis Bacon or Steve Cohen or Stanley Druckenmiller. You pick your one of the all-time greats, and any of the pods and pads Citadel there, they are navigating, if you think about it, on an intermediate basis. Did you get underweight 70s a year ago, and then have you been overweight for the past 4 months? Right? Was one underweight properly energy for the last 12 months? This kind of thing. And rotating and pivoting and delivering alpha that would be able to overcome the cost of trading and then to beat a long-term buy and hold. But to make just a conclusion based on one man, we all get up in bed the same way and put our shoes on, that for years to come, that kind of thing means nothing. Something to do with Jim Cramer. It's just a platitude. It's just a sentence written. Might happen, might not. But there's no insider that anyone can have to speak to that kind of statement.
Yeah. And listen, I guess why I bring it up, and I think why Doug is chronicling a bunch of these kind of proclamations about the markets and about, valuations. I mean, I want that in my head. And I don't mean like I want to be contrarian for the sake of being contrarian, but you and I have been around for a long time, and we kind of remember that some of these kind of rallies, they reach a bit of a fever pitch at some point, and they can continue to go. Let's kind of take a little stock here, what's happened over the last 6 months, right? And I feel like this has been going on since the Fed started raising interest rates back in 2022. Expectations into each year, whether it was, 23, the Fed was going to have to lower interest rates because a recession was imminent, right? In 24, they were going to be able to lower interest rates because we avoided a recession and things were going okay. Here we are into 25, expectations were going to be, again, pro-growth agenda by a new president that we've already known his kind of MO, right? We're going to have deregulation. We're going to have lower taxes or extensions of tax cuts, that sort of thing. And here we are, we're up 5% on the NASDAQ, 5% on the S&P. Both were down 20-ish% from their highs or a bit more at some point. Yields are at about the same spot, the 10-year. The dollar's materially lower, right? You have a crude oil that is down, at least on the quarter, down close to 10%, which is crazy to think about given all that we've had in geopolitics and the like. And so what have I said to you? All right, yields that don't seem to be going much higher. That has been your call for a while. Crude oil, I don't know where you are, but it doesn't. It's got these spikes higher on geopolitics, but it comes back. You know what I mean? We have a weak dollar. All those things you would think are tailwinds for U.S. equities, for U.S. multinationals and the like. So are we right now in the quarter, S&P's up 10%, the NASDAQ's up 17%. Like I said, they're both up 5% in the year. Does it all sound like we're about ready to go into crazy town here? Because if you think that we're going to get tax cuts extended, if you think that these trade deals are going to come and you think geopolitics are going to settle down, isn't that the conditions? I'm not making the case. I'm just saying this is some of the cases.
Yeah. I mean, I don't suppose any of those things, the geopolitics is priced in what we know and have. And I think the prospective tax changes are priced in. It's really going to be about the quarterly results, right? So if and as they're decent, does the market already price those in? It keeps the market here. Or if and as they're not decent, does the market give back? But a big press higher from here seems an unlikely thing on an intermediate basis, but we shall see. The interesting dynamic, of course, is it's as ever, it's the super cap and large cap names that drive the results, and that continues to be the case when you look at one index after another. Now, there are large cap names that were great participants that are stalled of late, considered the two great staples, Walmart and Costco, right? Not performing Berkshire. But still, we have a circumstance where if you didn't know what the news was and you observed the chart of the S&P when you just came in from, Rip Van Winkle, what was that plunge? And my gosh, there's an equal and opposite ricochet right back to the point at which the plunge took place. And if the person told you, oh, it was the craziest thing, there was this movement in the Congress to have the South secede. What? And they were getting votes, and the country's going to split up again. Oh, wow, that's what caused it to 20. That makes sense. That's pretty bad. Yeah, but then they squashed it. And now that's not, meaning it's not what the news is. You say, but that's not what it was. It was tariff. That's not the point. It doesn't matter. Something caused the sell-off. And it was short-lived because it recovered so quickly. So essentially, as the arc or trajectory travel, the S&P experienced a 21% drop, NASDAQ more, and we've recouped all of it. We're essentially plus or minus back to where we were. But the thing to point out, when we get into the charts, is that it's at the index level, right? In the S&P right now, 225 of the constituents, the S&P 500, are more than 15% below their own respective 52-week high. So it's the index that's done it. But we can look here. This is the big one. It's got the big favorites. And you can see the percentage figure included there on the top left near the title of the chart. The NASDAQ 100 is 1.69% above its former high. So if you were to say, what rate are we annualizing at since that high? We're annualizing about 2.5%. That's not a very robust market. But from the low of 2 months ago, we're annualizing at 200%. So it's where you want to start the narrative. But this is a new high. And what constitutes a new high versus a bull trap? You really have to clear it by about 3.5%. I spent a lot of time early on, 20 plus years ago, trying to look at stats on that and do my own work. And obviously, we're not there yet. But either way, it is a move above the high. For it to be meaningful and enduring, it's got to stick its landing, as the expression goes, like a gymnast that doesn't triple, quadruple flip. You got to nail it. You can't wobble or fall off.
Yeah, and I think it's interesting, Carter. So when you say 3.5% above that prior high, and obviously you're just kind of alluding to some of the work that you've done, and I'm sure this incorporates, a whole heck of a lot of data points over a long period of time. My question is like, I look at this and I say to myself, and I said this a month or two ago, I could not think of a scenario, given everything I thought I knew, and this goes back to what you're kind of alluding when we started off, that we would be making new highs for the balance of this year from a psychology standpoint, from so many of the concentrated trades, like you mentioned, the major movers or the major, concentrated names at the top of these indices, like that they were going to be able to kind of, I don't know, like get over the sort of, listen, it seemed like we had massive optimism in the Mag 7 at a point where we weren't seeing the rubber hit the road as far as the use cases of all the spend and the like here. And I'm not sure we still do, but they powered back. But you mentioned this is like Tesla, Apple, and I'm missing one. They're still down in the year. They're down considerably, down 20. Google, you know what I mean? So there must be other participants. I see JP Morgan making new all-time highs right now. So I guess my question to you is like, I didn't think that we could establish a new range above those prior highs. But here we are. You say 3.5% is the thing that lets you believe that we have a real new high. What is the condition in which you would establish a new range? Would you like to see a consolidation here in the SPX around 6,200, 6,250, and that would make you believe that,
We're backing away, right? You're backing away, going back to 6,000. All of that's normal. A big move to a difficult level, and then you set up. But just to press higher here, I think that's the low odds bet. I'd certainly write calls against many of their steep, uncorrected positions, and a thorough move above is best done by backing and filling here, and then moving higher. But you can see the difference, right? In the NASDAQ, we can toggle NASDAQ 100 S&P, NASDAQ 100 S&P. That one's a bit further along. Now, to make a contrast, look at the equal weight, which is the next one. The S&P equal weight, and that's 3.61% below. So that's either the opportunity or the problem, right? If laggards catch up, then the S&P itself will press higher as well. Laggards don't, or the extended names like the Roblox give in, you can just churn here. But as you go through these various indices, look at the S&P mid cap, which is, that's 9% below, or the S&P small cap. You'll see the next 14 in the Russell 2000, which is very similar to the small cap, down even 11. And so, it's a bifurcated market. It's been that way for quite some time, and it's almost always that markets are concentrated. We see that the great leaders, which sold off more than the market in the sell-off in many ways, have recouped. It's where the love is, where the money is, where the liquidity is, and it's where the dream is, right? There's no dream. Sitting here, should I pick Dow or DuPont Chemical? I mean, talk about boring, right? Ford or GM, Procter or Colgate. The way forward is trying to find innovation, growth, future. And then it's always a question of whether you overpay or not. Roblox, NVIDIA, or Palantir,
Yeah. All right. Let's see if we can flash up a BKX for a second here. And then I want to go to the KRE because I think it's a kind of similar sort of condition that you're talking about, right? If you look at the kind of mega caps and then you look at, let's say the small caps of what we saw here. So, this is one we just talked about, that JP Morgan making new highs, Goldman Sachs making new highs. Obviously, this is I think it's not a top heavy sort of index. I mean, I'm thinking just give me your 411 here because we're reaching a level that we were at kind of late last year, early this year, and then we're back here. Any thoughts on the BKX?
And there are others. If you were to put just to by juxtapose, look at American Express to put that up if we could, and then we'll go back to the bank. It's the same thing. So you have some major financials that are just right at former highs and are contending with the prospects. There's another, right? So Goldman's a little bit through. Citibank not quite, Wells Fargo not quite, JP through, Amex there, but back to the BKX. So that is what breakout setup looks like. You get too high, and then ultimately you exceed it or not. But it's also where often tops are made. So we're at that critical juncture, and that being a little bit above a former high is not a breakout. That's the point, right? It's clearing with vigor and conviction. It's after resting. So this is a big moment, and what's going to resolve it is the earnings. It's very simple.
Yeah. Let's pull up the KREs. This is regional banking index here. And so this is not too different than looking at the S&P, I think, and then looking at the Russell 2000.
Same exactly.
Yeah. But let me ask
you. It's tempting to say that it's moved above the downtrend line in effect since the December peak and all that. But basically, it's not an interesting creature here. It's an instrument. It's just, all right, it sold off a lot, it ricocheted a lot, kind of stuck, pair of twos.
All right, really quickly, I want to ask this because this is a question that I may some of the viewers might have too. Let's go back to the BKX for a second here, and if you look at that consolidation that we had before it just kind of took off, just 2 weeks ago, it was kind of in and around. It was kind of holding that 150-day moving average that you look at. Now let's go back to the KRE for a second here. The KRE looks more like resistance, and maybe you're going to say that's not that. Maybe it doesn't look that different to you. I'm just curious how you think about that.
Yeah, it's just a little bit weaker, right? But the setup is the same. The ricochet for X number of days, and then the sideways, the rest consolidation. Now, the larger banks have resolved up and out. The carriers still in the formation. The question is, do they get resolved up and out? But there are many. Just to make a point, look at BPOP. Put in BPOP. So this is an important regional bank, just to put in context, and you'll see that it's, look at this stuff. There you go. It's up and out, right? So there's always one, and that's what alpha is, right? You're trying to find areas and themes within the market or within sectors of the market and find what will likely outperform this regional bank versus regional banks, or JP Morgan versus banks in general as measured by the KBW Bank Index.
All right. I'm sure you get this question. You sit down with institutional investors, large hedge funds, mutual funds, and the like, and they love your work. You've been doing with many of them for decades. Do you get questions at periods like this from institutional investors saying, okay, we're full up on the big ones, and you know what I mean? They're the ones that helped us get to these new highs, that sort of thing. I want some laggards. You know what I mean? Is that a reasonable strategy after you've seen, this sort of move in the major indice? It's probably defying a lot of folks, a lot of the smart money. I do that in air quotes here a little bit. You know what I mean? And now do they want to kind of go further afield from the mega caps?
Well, it's really mandate related, right? So if you are a growth manager and you're large cap, trying to find a bearish to bullish reversal that's smaller cap is just not within your bailiwick. So it's, if you're taking that exact question, you'll be like, well, if Roblox seems a bit full here, or Palantir, what would you consider as a prospective large cap prominent name that maybe could take some of the money if and as we trim a Roblox? And then it's a question of, well, is IBM ready to go? Oracle just broke out, right? Or is it finally time to catch a real sleeper like Intel versus others? Or look at Avago just now breaking out. Not as steep as a Roblox, not to keep saying that Roblox, but that's particularly steep. Or something that's really shot the moon off the low like MU. Let's pull up a chart of MU and say, hey, look, is MU just too steep and uncorrected? And could we find ASML, for instance? There's MU off the low, and look at ASML, where it's just starting to curl up, and that would be more of a nascent. So there's a bit of that, but it's not, and that's a little calmer and so forth. So there's that kind of thing. But generally speaking, people are so by mandate in such specific sleeves. So you have the mid cap TMT or small cap value, but no utilities and REITs, only consumer, that they don't, most don't have the wide ranging. It's just, all right, sell all these, then let's buy some dogs down at the bottom. Yeah, that kind of thing.
Well, the reason why I asked that question is that when we go back to how we started with some of these kind of proclamations of a new bull market, and it's about to get crazy time in this and that, whatever, you'd think that rising tides lift all boats, that sort of thing. And so you hear about broadening out and all this stuff. And sometimes if people don't care about valuations, then, it's one thing if they don't care about valuations when growth stocks that are working, they go from 25 times. Oh, that was expensive to the market. And now it's at 30 times. Well, that's expensive to itself historically and many of its peers, right? Well, then you say, all right, let's go for these value traps. Intel's been trading at 13 times. Semis are making, like 52-week highs. That's kind of what I was kind of getting at, I guess.
Sure. No, I understand exactly. And there is that. But again, that's only if you're a generalist. Some people just can't. So just as a growth manager, it has to have a certain growth characteristic on a quarter over quarter, year over base, both gross margins. So they can't do it even if they wanted to, right? They like to just dump traffic and value. Just that the value guys are never going to, buy steep and uncorrected growth stocks.
All right.
I'll give you a good anecdote that puts this in perspective. For years in Boston, just two particular PMs, we go out to lunch every time there, more a casual thing, even though I met them in the daytime. And you can think of some of the big firms out there, we'll leave those names out. But, one just always would say, hey, listen, just Carter, just so we're clear, unless it's making a 52-week high and all-time high, they'll call it. I don't want to know the ticker. And the other one, literally over the next bite, and Carter, for me, of course, unless I'm making a 52-week low and all-time low, just lose my number. And I don't want to hear from you. Well, what do you think? One guy's a growth guy, and one guy's a value guy. That's it.
Yeah. All right. You brought this up a couple times, and it's not a name I've looked at in a while. We got to look at Roblox for a second here, because I was just pulling this up as you're talking about it. Here's a stock that was a COVID darling. Let's go to a 5-year for a second here. It was a COVID darling. We saw a lot of weird activity. If you had kids who were probably of the age of using Roblox, they were probably those first few months of the lockdowns or whatever, they were just on the Roblox all day, right? Doing that sort of stuff. But it's interesting that move, the stock had gone public in 2020, and then it consolidated, and then it just took off, but then it lost 90-some% of its value. It was kind of stuck. I'm sure this is a name at some point you were saying bearish to bullish reversal, right? And that looks beautiful. Now let's go to a 1 year. This stock is up 100% off those lows just, from April. And I look at this, and I know you don't care about this sort of stuff, but it's the sort of thing that gets my antennas up. This company loses a lot of money. Okay. So net income loss on a GAAP basis this year is expected to be close to $1 billion, which is up a little bit from last year. Revenue growth, okay, fine. They did 3.6 billion in revenues last year, supposed to be 5.3. Next year is supposed to be 6.3. So you see a massive deceleration in revenues. The company is losing money, okay, like a lot of money, right? If you think about it. And, margins are kind of flat here. So when you look at a stock, like make a move like this in a 2-month period or so, what is that saying to you? Because to me, I want to short it, but I could have said that at any point over the last 2 months. It would have been losing a lot of money.
Yeah. Well, a couple of things. Obviously not for the faint of heart. To think that when the market dropped 21% in the February-April sell-off, right? February 19 high, April 7th low, this lost what? It went from 80, 79, 80 to 50, lost 35% of its value. And then here it's doubled, which just speaks to the vagaries of the whole thing. Is it worth 50? Well, apparently it was in April. Is it worth 100? Apparently it's now. Is it worth 78 or 80, where it was in February? But either way, it's an incredible angle. It seems remarkably almost like a fat finger, like someone who was just leaning on their computer and buying 10 million shares every day and didn't notice it up at a big $1 trillion asset manager. But as to the loss of money, that ultimately has to get reconciled. But for now, the way we've chosen to do it is we did a strangle over the weekend. You wouldn't believe what you can get for the 1,500 calls expire 3 weeks from now, 14 days because of the holiday, and the 11. What is it? Well, I'm getting the numbers wrong, but it was literally you got a 25% return if it doesn't go 10% higher or lower. There's no earnings coming. 10% higher from here, I would love to short the stock, right?
Yeah.
10% lower, you're buying something that's obviously in favor at a discount, but we shall see. It's an unusual angle. It's unusually complacent with little volatility, and I would bet against it.
And just to be clear, those strategies, we have Michael Obachina tomorrow on the market call. He is the head of options trading at Robinhood. And he and I are going to talk about your different strategies. One of the things in your trading system, if you just price that up, it takes a lot of margin to do those things. So like selling strangles. And so what Carter's talking about right here is, or straddles, which is, the out the money call and put in the straddle. Strangle is an out of the money call and out of the money put. It just takes a lot. These are like professional trades. They're looking at vol and that sort of thing. Selling it out of the money call and selling it out of the money put, you got to put up a lot of margin for that. So sometimes that's a hard trade for a lot of us folks who are trading at home. Carter, I want to hit a couple questions that are coming in from some of our friends here. Microsoft and Meta, this is from the Situation Room. I like that name. Microsoft and Meta have the strongest moves in the group. I think they're talking about Mag 7. Now, Microsoft's an interesting one because this was one of the early beneficiaries from this generative AI trade going back, a couple years or so. You see that gap on earnings. This was the first day of May, and it kept on going. You want to put a 5-year on that, guys, and we'll see that, this is just basically, off to the races here a little bit. And Meta, I don't think Meta has made a new high, but let's stick with Microsoft for a second here. Thoughts on this? Because if these major names have been powering the moves in the NDX and the SPX to new highs, what do you do with some of these names here?
Yeah, I mean, just as a simple, it's what trimming, right, is the incremental move, just as one can add to a position as it's developing. When something's getting steep, and then pulling in one's horn, selling it all, that doesn't quite seem very prudent. Buying more, equally sort of one-sided. You trim longs, and you sell calls against it, act on the increment. What we do know is it's far above trend, and it's come a long way. Obviously, it was a news-related move initially with the gap, and now you have price discovery, if you will. We're weeks and weeks away post-gap, and so whatever news that was, people had a chance and time to assess it, appraise it, and act on it or not. And now trim longs for sure.
Yeah, pull up Meta really quickly, guys. This stock is up 55% from its highs, from its lows, excuse me, just 2.5 months ago. And you look at this and you just do the math and you talk about how much market cap it's gained. I suspect you're going to say kind of the same thing. But I guess the question I have, Carter, that 150-day moving average, right, off the 22 lows served as amazing, support, right? It's just an uptrend there. And when you see the sort of break that we had, from 600 to below 500, below that moving average, below that uptrend, what is I would have said that's something that's going to keep it down for the count for a while, but the fact it just blasted through, gapped up through it, and now it's back at those prior highs. Is that important to focus on that uptrend, the 150-day?
How would I measure it? If it were an individual circumstance, and then you would say that is completely rare, unusual, which it is, to have that aggressive a break and that equally aggressive recovery, saving the moving average. But it was everywhere, so that we start to know that it was totally a market-related thing, and it turns out maybe artificial, right? Or maybe something that was self-induced, shooting oneself in the foot, so to speak, and then the wound is gone. Meaning it's atypical to be in a good uptrend like that, and then to undercut your moving average, whichever one you use, and then to quickly recover back above it. And so one would say that must have been fake news or something, not to be fake, but an erroneous a rumor of the Justice Department looking into Meta, and then it was resolved, or a short report, and then it was resolved. But in this case, it wasn't. It was every single stock in the market. And so that, not to say excuses the break below the moving average, but it ameliorates it to such an extent that one could say you almost white it out, because they used to do it, the white out in school. Now you black it out on the screen. But what we do know is it's right back to the former high. And here too, before exceeding that in any sort of real way, I would expect a lot of backing and filling.
Yeah. All right. So we just highlighted two of the best performing in the Mag 7. Let's look at Apple and then Tesla, the two worst performing. So, it's interesting to me, Microsoft's up 18-ish% in the year. Meta's up, 27% of the year. Apple's down, 20% more from its prior all-time highs. I mean, this thing just acts like unholy death here. And I'm just curious. I mean, I think I know what you're going to say, but I'm just curious, relative to its mega cap tech peers and relative to, let's say, how this thing, I know you're going to say the relative performance over the last few years has been really bad. I'm just curious, where are you on Apple right here?
Yeah, just no change. So the relative peak to the other choices one could have made, right? And that's all it is. Folks say, oh, relative, but relative's important. I mean, the greatest example of that ever is literally sitting at the dot-com peak. People talk about barbecues, and oh my God, I'm up 27% on this one this year, and I'm up 13 on this one, 19 overall. I'm up 24%. And then guys looking at you like, dude, I've tripled my money. What the hell happened to you? So the point is that alpha really is just about the opportunity cost, or what choices could have made in lieu of the choices that were made. And so regardless of what Apple has done, it's not been happy. It's really done something quite astonishing. Its relative performance to its peers, if you can say it has a peer, but because we have the Standard & Poor's Corporation putting stocks into baskets known as sectors, the technology sector, and Apple is in it, obviously, its relative performance to its sector peaked 3 years ago in September of 2022. So in about 6 weeks, will be a full 3-year peak. Now, at some point, one could say, but isn't it cheap? Isn't it worth? They have all that cash, they can buy back themselves. Oh, all of this is true. But I like to see something happen before. I would love to see a heavy volume spike to and above 210, 211, little back, and then another one fall to 214. I was, all right, maybe this is, maybe this is going to get in play here. But right now, there just is no premise other than, hey, I feel as though it's cheap, I should do it. But that's not a technique. That's a personal thing. And it means nothing. Or maybe it's the greatest strategy of all time, but it's not replicable, right? And so for me, pair of twos.
Yeah. All right. Last one before we get out of here. Tesla Wednesday morning deliveries. We look at these sorts of events. The options market is pricing a 5.5% move in either direction. It's interesting with this name that so much of the fundamentals are debated so hotly. We've been talking about a Q2 delivery number since the Q1 delivery number came out. And this isn't even earnings. This isn't even broadening out what all these other, one of the biggest driver of the stock, of late has been robotaxi. And then, Elon keeps talking about robots and all this sort of stuff. But this is one where, last Monday we walked in and the stock gapped up 5% and was up 10%. And people were, wait, they put 7 robotaxis on the streets in Austin and that was it. But it quickly, after 2 trading days, gave it all back here. So curious here, I suspect you're going to say something very similar, but if the company were to be able to guide deliveries that are better than expected, and then be able to kind of give some sort of comments in the press release that was it. I mean, the stock is obviously on its way to 400. Not obviously, but it could be. So curious how you think about this thing here.
Yeah, I mean, it's not a default answer when it is a pair of twos, and that means what it is that when you have a small hand, a small play, a small opportunity, go small, small short, small long. The big setups are big. And, history reveals that when you have, rare, big moments are rare. When you have it, you go with conviction, you go large. This is not that. It's not all that worrisome as a chart, but it's not very exciting either. I would just stay away. The temptation is to then say, oh, but there's news coming, and therefore, if the Fed does cut rates, or wow, if JP Morgan does go through the bank test pretty well, that's a bias. That's not what charting is about, right? So this is a non-chart. It's a pair of twos, not particularly bearish or bullish. No discernible immediate opportunity on the long or short side.
Hey, Carter, do you have, and honestly, if you don't have time, tell me not. But do you have time for a couple questions really quickly?
Please, yeah.
You sure? All right. What does Carter think about Nike? So let's pull up Nike for a second. We know that it had that massive move on Friday. Earnings, they kind of talked to a bottom. It gapped right to your 150 or right above that. If you want to pull up a 5-year, we've been talking about that, and then go back to the 1 year. I mean, this was one of the very few, mega cap stories that went through its COVID lows. I'm just saying that's purely anecdotal. Thoughts here. Does that gap on Friday change anything if you're thinking about it on a long-term basis?
So the COVID low was exactly 60, and the stock just as recently as April undercut its COVID low, albeit barely, and it is holding at that low until the news-related gap up last week. And so, strangely, 3 of the stocks we wrote, we did strangles on this one and on Microsoft. But the point is that after this re-rating, the temptation to think, okay, it's off the race. It's not off the races, right? It's likely to do a lot of back-end filling and playing for a vol crush, just as you see in spikes in oil or spikes in the S&P, or drops in the S&P and then the vol collapses. What is important to say, though, because of the heavy volume not depicted here on the day of the gap, it establishes the April lows as major lows. One, because they were essentially at or just below the COVID low, but now that kind of move above those lows on volume make those lows good lows. Now the question is how high and over how much time. But my hunch is to buy dips here, not to be long here and now. If you're long, I would sell calls.
All right, quick one. This is from Dan N on that same chart. If it were to go and fill in most of that gap, let's say over the next week or two, would that like kind of change your mind about buying dips?
That's what new. Yeah, that's what new. That's a new money entry point. But here and now, to have if you to put new money right here and then have it fill that gap, you're in the hole right away. So if you just can't resist, I would go small and then save cash for the prospects of some filling of the gap where you can buy more at a more favorable price. If one is long, I would sell calls.
All right, really quick, XLE, large integrateds make up, what, 30, 40% or something like that. Guy's been talking about this one. It's kind of stuck in the mud here. I'm just curious, like, is there anything that sticks out to you that is at all interesting, long or short side?
No, and if you did a longer term, this is just, it's stuck. This is also fair. So just to put it in context, we know that this was the single worst area of the market going into and during COVID, right? I mean, nobody's driving, no planes. It's just literally the worst single theme sector in terms of underperformance. And guess what was the best theme, bar none, off the COVID low? Energy. So now all the planes and cars are moving again. But here and now, it's kind of a pair of twos. It's just, sometimes the best investments are the ones you never make. It's just, there's no reason to do it.
Yeah. All right. Well, I appreciate that. I mean, to me, it looks really weak. And just like to your point, it's been this long consolidation and it can't get going in any sort of like environment, whether we're in an inflationary environment, whether we're in a good growth environment or bad, it just kind of stuck. So listen, I really appreciate you doing a lot of heavy lifting here, Carter.
See you Wednesday.
Monday. All right. But thank you so much for being here.